So to beat the market maker trading theory is mainly spotting and trading traps. Trading traps will help you monetize off the uninformed trader's misfortune and simultaneously take a trade alongside with the market makers in the direction they intended. So these market maker traps occur in the beginning and the end of the week, the beginning and end of the day, and the beginning and the end of the session. So let's start off by analyzing our weekly profile, and we're going to build our approach from there. Let's talk about the weekly market maker cycle. So again, we know that traps occur in the beginning and the end of the week. So if price wants to go bullish, go on a bullish week, then the initial trap would be bearish, and vice versa. If the week is bearish, the initial trap would be bullish. So here, early on in the week on a Monday, you see an aggressive drop and price expands. What does that mean? That means all the sellers been trapped. Anybody that wanted to sell and thought the market was in a selling profile got trapped. And as the days go on, these sellers have not been released yet. Price did not approach that area again, did not release their stop losses. So these sellers are trapped. So as the end of the week comes, which is Thursday and Friday, you would see another trap, which would be a reversal. So let's talk about our weekly market maker model. So let's say this is a weekly candle. You go on a weekly time frame and this is your weekly candle. So each candle has a price opening, which is where the price open. It has the bottom wick, which would be the low of the week. It has the body, which is the expansion, and it has the top wick, which is your high of the week. Again, let me try and explain this in our weekly model. So price opens up just how it opened up right here. So price will open up and then drop. What is this drop? This market maker trap here is our bottom wick. What is the purpose of this wick? The purpose of this wick is to fake out all the sellers. So everybody that thinks this is a bearish week, they get trapped for price to later go through the expansion, which is the body of your candle. Price will expand. Once later on in the week, which would be your Thursday or Friday, this wick will occur, which is your reversal for price to finish out consolidating. So price open right here, which is this area here, the expansion, which is your body, and price close, which is right here. This weekly model is the representation of your weekly candle. Again, you have the trap in the bottom and you have the top reversal for your top wick. So a main overview of a BTMM weekly cycle is if it's bearish, you're looking at a M, A, W. This would be your bearish cycle. Now, if it was bullish, you're looking at a W, V, V, M. And stick to this guide to keep it simple. So let's take a look at this example. We understand that the trap happens in the beginning of the week. So the week starts off and it automatically tries to induce traders into taking long positions. So on Tuesday, it can reverse with the M formation and then drops. So then later on, finish your week off with a W to finish off consolidating. So what we're going to do next here is we're going to add more context. And how we're going to add more context? By using smart money concepts and combining the both of them. So now we're going to combine the weekly market maker model and smart money concepts. So here, this would be your macro time frame, which would be your higher time frames. Of course, on the micro, where you're looking for your weekly model, you're looking at the 15-minute or the 1 hour, obviously for clarity. But prior to this, you want to look at your 4 hour, your 6 hour, your 8 hour, maybe even your 12 hour. And you want to identify your major swings, which would be your peak swings. Once you identify your swings, what you're looking for is major level of discount, which would be your extreme, of course. And in this case, let's say you have an order block right here. And the only reason we would even be interested in taking this order block is because of the inducement. You would want to see price open up, take this level, take the liquidity above this swing, tap your order block, which would be your trap. This is where the M would occur, and continue lower for the later of the week reversal. This is exactly what you would want to see. You would look for a significant order block, which has to be not mitigated. So again, there's probably an order block here. This order block is definitely mitigated. So you would look for an unmitigated order block, and you want to see if there is a swing post that order block forming, because that swing will be where the orders are resting. And for a high probability weekly model, you would want to see that liquidity taken, purge to occur. Once that purge happens, and you got to make sure this happens at the latest is on Tuesday. The latest, preferably if it happens on Monday, Sunday, Monday, which is basically one day when it comes to FX, because Sunday is half a day. Tuesday is the latest. You would want to see that market maker trap happen right here. You'd have your M formation here, and then you'd want to see the market drop. So now that the new week is going to start, what you want to do is you want to go on the higher time frame. So in this case, I'm going to go on the 4 hour. I'm going to look at the market from the 4 hour, 6 hour, 8 hour. Just looking to see where I can see the clearest levels. So what we're going to do next is we're going to mark up any inefficiency that hasn't been mitigated. So we're looking for inefficiencies that has not been mitigated. So we have one right here. I have a higher time frame inefficiency right here. And we have another one right here. Why am I choosing these? So the reason I'm choosing these inefficiencies is because, one, they're at my extreme range. As you can see, these order blocks are in extreme zones. That's one. The second clue here is both of them have micro swings. So this one has a macro swing and this side has a macro swing. What is a macro swing? A macro swing is our inducement, which is basically anybody that purchased price over here for this small run. Their stop losses are right here. So what we're trying to do is take their stop losses, attack our extreme order block to expand, and potentially this be the weekly trap. On the other side, anybody that sold price over here from taking this micro OB, their stop losses would be right here. And the goal is, of course, to take their stop losses, form our formation here, drop down. This would be our purge, and to continue the week and then later on maybe consolidate. So now that we have our zones, let's react to price. Again, you're not trying to anticipate anything. You are just reacting. Where the price open, price took out the liquidity level right here, and it's heading for our OB. So now Monday passed. Now what we're looking at is for price to reach our OB on Tuesday. Now, if it reaches our OB on Wednesday, this is not a part of our weekly cycle because we said the traps only occur in the beginning of the week or the end of the week. And here is your reaction. And if you zoom in, go on the 15-minute time frame, what do you see here? You see your M formation. And what is your M formation? Your M formation is inducement, liquidity grab, and down into your OB. That's all it is. So the same setup you're looking at on the macro time frames, you're looking at the exact same setup on the micro. Why? Because price is fractal. Now you go back on the 1 hour. And again, now it's Thursday. So what are we looking for? Now we're looking for price to take this level here and continue lower. Okay, price looks like it might not reach that level because a reaction already preserved and the week ends. So again, your reaction was the early of the week trap, and the trap occurred in your unmitigated order block formed by your purge. And if you want to look at it from extreme, smart money rules, go on to 4 hour. What do you see now? This is your purge. And if you want to take it a step further, you can say this is your buying climax. This is your test. And this is your purge. So these are the exact steps you want to follow to grab your weekly high or weekly low. So let's talk about the intraday cycle. Price goes into an accumulation, and this accumulation is occurred during the Asian session. Once price breaks out of that accumulation, it induces traders into taking short positions because breakout traders think this is a breakout to the short side, but price turns around and starts a bullish trend during London to then later find a reversal, which of course occurs during New York. And this is basically it. It's an accumulation, manipulation, distribution cycle, which occurs on the intraday time frame. And the most important thing is to pay attention to the initial base of this whole cycle, which is your Asian session. If your Asian session is not consolidating, then this cycle is not existent. So the main thing is the first step. So you need to make sure that whenever you're looking for this cycle, the Asian session did what it was supposed to do for. So let's talk about the intraday market maker cycle. So here you have your Asian session where the accumulation occurred. Again, if you look at the accumulation cycle, this breakout right here would induce a lot of shorts. So a lot of retail traders will try selling here. There'll be sells here, maybe even sells here. So what does the market do? They drive price lower to trap all the sellers to go with their initial move. And as you can see here, price expanded and reversed during New York. So the best strategy you can use when you're using the SMC and the BTMM strategy is your London session trade. And how you would trade it is you have your range, which would be your Asian session accumulation. So what you would want to see is you would want price to manipulate. After the manipulation, obviously forming your purge, which would be forming your purge. And you would want to see a break structure. So basically, price is taking out the lows and the highs of the Asian session as liquidation. And once price does that, you're looking instantly for a RTO, which is anything inside of this range. Again, take out the Asian session concept out of it and focus on the purge and the break of structure here. So what you're looking for is an unmitigated order block. So you'll find one here, and you will take the trade here all the way until the start of New York session. This will be your trade. Again, if this trade occurs later in your London session, maybe like the last 30 minutes, or in New York session, then this trade does not work. The best time to take this setup is through your London session. Again, to keep it simple, manipulation, which is taking out the liquidity on this side. Break of structure, taking out the liquidity on this side, which is an external to external change of character, comes back inside of the range. Comes back inside of the range, you need to look for a high quality validated order block or a high probability validated fair value gap to take a trade and ride it all the way until New York session. Okay, so here you have your Asian session. We're in the 5-minute time frame. And the trend here is bearish. So what are we looking for if we know the trend is bearish? We're looking for a opposite direction purge. We'd look for a manipulation here for price to take this level here, take the liquidity above the Asian session. Once the liquidity is taken, price to break structure. And then we'll be looking for our PD arrays, which could be our breaker, order block, or fair value gap. So now you have your liquidity taken. Now what you're looking for your break of structure. Again, we're focused on major break of structure. So we would want to see this low get taken out. So we have our break of structure. So and price came back inside the range. So the first thing you want to look at is your time. It's 5:45, so it's still not New York open. We still have 2 hours. So what are our entry points here? We have a OB right here. And we have our breaker right here, which is the shelf. We have our breaker here, which is our shelf, and we have our order block right here. And if you look up right here, we have an extreme OB, which is your return to origin. So again, the safest option, of course, is to trade the extreme OB. But when you look at the time, in this instant, it's already 5:40. You can't expect price to come up all the way up here at 5:40. Maybe if it was 5 o'clock or 4:45, then maybe you can anticipate this move, right? If it was early on, you could probably anticipate this move. But the fact that it's a little bit later on, you might not get this entire move. So this will be the safest approach. Then you have your OB, which is right here, unmitigated OB. And then here you have your breaker. So these are your 3 options. So as a trader, you want to develop your trading strategy based on your personality. So if you want to get in more trades, you would take your first PD array, which would be your breaker here, which comes first. If you want to play it safe and you don't really care about entering many trades per week, then you can take the furthest, which is the safest, that can give you the smallest stop loss. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe. Make sure you guys follow me on Instagram, and make sure you visit the website.